Hello and welcome to FinTech Impact. I'm your host, Jason Pereira. Today's show, I have Vieje Piauwasdy, Director of Equity Strategy for Secfi. Secfi is an online platform that allows employees of private companies to basically monetize on their options and cash out before waiting for an exit from the company. And with that, here's my interview with Vijay. Vijay, thanks for taking the time.
Thanks for having me, Jason. Really excited to be here.
Yeah, well, interesting topic. And we just shared some stories about some interesting VC stories and books that we read recently. We'll get into that later, maybe. But let's start off with Secfi. Tell us about Secfi.
Absolutely. Happy to, again, thanks for having me, Jason. This is awesome. Always excited to do these FinTech podcasts. So in short, what we do here at Secfi, we help employees with their stock options. So maybe going back to our founding story, the company was started just about 4 years ago based off personal experiences. Our two co-founders were early employees at a fast-growing startup. And most of your listeners will probably know where this story's headed, but they were early employees. Companies started growing like crazy. Little do you know, funding round after funding round. Next thing you know, they had highly appreciated stock options. And long story short, what they did was they realized that, hey, we are at the point where we need to exercise these stock options. And this tax bill to do so is going to cost us close to $1.8 million to exercise. They couldn't find help. They tried to find help out there in Silicon Valley, tried to talk to VCs, private equity firms, anyone that would help them, give them a loan to exercise them. Couldn't find a solution. When both of them had 90 days to exercise their options, they ended up losing them because they couldn't find the help. Both of them decided to leave the company to look at starting their own venture. And we're stuck in this terrible situation, highly appreciated a stock that's quote unquote paper money, but no way to access that, right? In order to access that, you're going to need liquid cash of close to $2 million, which not many people have. Bank accounts. So that was the founding story of Secfi. They realized this is a terrible problem for themselves, but also for a lot of other people at fast-growing startups. And they started Secfi to help solve that problem. If you fast forward to today, Secfi is a VC-backed startup. We've worked with hundreds of thousands of employees, ranging from startups all the way from the seed level, all the way to the companies that are pre-IPO. Some companies we worked with that just recently went public in the past year, some household names, Airbnb, DoorDash, Palantir, just to name a few. And that's really the founding story. We really operate on two fronts here at Secfi. The first is in education. It's part of our mission to help educate employees, help them understand their equity and make the best decisions so they don't end up in the same fate as our founders. Second, we do provide financing solutions for these employees as well. No matter how much you plan around your equity, sometimes your company just grows a little too fast, and you're going to need help to exercise them. You may have, or very likely most of the individuals we work with, 95% of their net worth is tied up in these stock options. And, to diversify, even if they do have the cash to exercise those options, they may not want to take such a risky position. So they'll work with a partner like Secfi in this situation to exercise their options, pay their taxes, so they can get ahead of any tax bill. And that's the background on Secfi in a nutshell. We really operate in a very niche industry here. Our clients are primarily employees and executives of fast-growing startups. And, it's again, very niche. Not too many people outside of the VC-backed startup world really know about us.
Excellent. Well, outside the VC-backed world, there's not much reason to basically deal with you, quite honestly. It's not the same problem when you work for a bank, right? There's no liquidity issue. And this is an ever-growing, I say ever-growing problem. This is an ever-growing nice-to-have problem, right? A lot of the appeal of getting in with a lot of these startups is that, hey, maybe you get on the next Facebook or whatever else it might be. For example, I just looked up SpaceX's stuff on your calculator, and it's like you're a company that you're getting richly rewarded in shares, right? And if you're not publicly traded and the timeline for exit is God knows when, how do you basically make the most of that and get out? So it's and actually live your life as opposed to waiting for that altogether. So I totally get how difficult that can be.
Yeah, absolutely. And, it's a good problem to have, right? I wish I had, stock options that were insanely highly appreciated with the tax bill I didn't know how to pay. It's a great problem to have. It's an enviable position. And that's why someone goes to a startup, right? Or I guess one of the main reasons you go to a startup to get equity in a company, and hopefully, that company continues to grow and you'll have a nice payday. but it's a problem nonetheless. And the problem that a lot of people unfortunately don't plan around and start talking to advisors like yourself, Jason, about how to plan around our equity. Usually the trigger point for when someone comes to us is right before an exit. And quite often, unfortunately, that's a little too late, right? The company's already gone through multiple funding rounds. The stock is so highly appreciated that they may be in a very tough situation overall. So it's a very interesting industry to be in. I think, you can go back to when we started this thing 4 or 5 years ago. Equity was a very taboo topic. It's something you don't talk about your coworkers. It's kind of like talking about your salary, right?
Yeah, it's a sensitive topic because and let's face it, not all employees are valued the same way. And just like a salary issue, what do you mean you got that many shares? I've been here longer than you, or whatever it is, right? Or I'm more valuable than you are. But so many variables, like when did you come into the business? What was the role at the time? Like any number of things, right? So let's stop from that. So let's take a step back. There's a number of issues or problems that to be solved around this. So the first issue that jumps to mind is basically, okay, I've got a highly appreciated stock. Let's say I work at someplace like SpaceX, whatever it is, or, we could have picked any of the more recent big names that went public. Well, I won't go to Robinhood because I despise what they stand for. But so I've got highly appreciated stock. I would love to monetize on this, but oh my God, not if I exercise this stuff, I got the tax bill, got all this other stuff. First problem that jumps to mind is I can provide you with proof that I have the options, fine. But what about the valuation of this? How are you solving for that problem? How are you basically saying, okay, yeah, we think the company's worth X?
Absolutely. No, I think that's a tricky subject, right? As you and other listeners of podcasts know, private company valuations are very subjective. As we were talking about this before.
And sometimes wrong once they hit the open market. Let's continue on.
Absolutely. And especially in this day and age where valuation numbers are just thrown out and I feel like they're just spinning a wheel and seeing where it lands at times, right?
Well, we just finished talking about cult of we before we jumped on here. So talk about highly appreciated becoming no appreciation.
Right. Absolutely. But, I think what's interesting about this industry, right? I think stock options in general, it's information asymmetry, right? You have VCs that know much more. They have more data points. They have more pitch decks. They work with hundreds of different companies. They understand valuations. And when you look at employees and founders, they really don't know too much. Most people this is their first or possibly second startup, and they don't know what their shares are worth. They don't know what the potential value of their shares are. So here at Secfi, we really operate off of, and we obviously add a financing solution to all this, but really it all starts with education, right? Understanding where you stand on the spectrum, understanding your strike prices, where that's at, what valuation your strike and your options are at, understanding the current 409A, which is the valuation of one common share here in the US. It's an IRS mandated number that's every startup's required to get. And then talking about the funding round and trajectory, right? Because employees do not get they don't get preferred shares. They get common shares. But the preferred share count is really a number that matters quite a bit, right? Because that's what investors are aiming to hopefully make money on. So it's really about education. We help people understand that, and we'll provide a lot of data solutions. We'll provide a lot of data analytics to all this as well. We'll help our clients model out different scenarios if they have questions around it. Here's what other companies that we've seen in your industry look like, right? Here's a growth trajectory. It's an imperfect, obviously, again, private company valuations, it's very difficult, right? There's no active market for the shares, unlike public companies. It's a difficult, it's a difficult number to come up with. But our stance on this is let's provide as much information to this individual as possible. Let's give them data we have. Let's give them the information that's on our platform, and let's help them make a decision for the valuation or equity.
Excellent. So basically, someone goes in, they figure out valuation. One of the issues too. So one of the big issues as you addressed is if you exercise these things, what kind of tax implications are we looking at? And that's further complicated. I'm guessing you have to educate people on what ISOs versus non-qualified stock options are and watch them basically get a little bit upset at the difference. But the reality is that, so you basically say, okay, we solve for the problem of, all right, we think we've got some sort of reasonable valuation on these stock options. You want to exercise them. So how do you help facilitate the exercising of this? I mean, of course, you're financing the purchase of these things. So involved with that, there's a number of permutations, like the capital that you have to give them, the terms, and the security aspects. This is like any other kind of loan, right? Like you're loaning them money. all the standard 4Cs of lending apply.
Right.
So talk to me about how much how the collateral works, and how the loan offers work.
Yeah, absolutely. So at Secfi, what we offer is just completely non-recourse financing. So the way this
No
works,
margin calls. Awesome.
yeah. Not necessarily, a little bit different. So the financing is collateralized only by the shares, right? So let's use a situation. Let's use SpaceX as a simple example that you brought up. It's a fun one. Let's say an individual is an early employee at SpaceX, low strike price ISOs. So valuation is obviously through the roof. As part of this, they're going to have a huge AMT bill for, without explaining what the AMT is. I don't want to bore you with
Alternative minimum tax bill.
Let's call it tax.
So many countries have a version of it too.
Absolutely. So let's just say an individual needs $1 million to exercise their options, pay their taxes. We'll calculate all that number on our platform. At Secfi.com, we've, from a U.S. State and federal standpoint, we rebuilt the tax code. You can type in your grant details, use our free calculators at Secfi.com. We'll have all that information on the back end. So we'll work with this individual to forecast their tax bill. For simplification, let's say an individual needs $1 million. We give that $1 million on a completely non-recourse basis. When we say non-recourse, the idea behind this that we're assuming a downside, right? And the reason we're able to assume the downside in these positions is that we only work with fast-growing startups with the reasonable means to exit, right? We underwrite every single company we work with. Very candidly, we say no to 90% of the companies that come through the platform. They're a little bit too early for us. We have a minimum mandate in terms of valuation. So we work with...
You have to be reasonably certain these companies are going to exit in a or exit at all. There's a market for it, right?
Absolutely.
I'm not going to press you on how much WeWork exposure you guys had. But...
It was zero.
they didn't pass your due diligence? Congratulations. Unfortunately, a couple of VCs are embarrassed by that. But anyway, continue.
Yeah. I've got plenty of stories for you. Maybe we can save it for the end there.
Yes, after you're going to tell me about the craziest ones you've heard after this is done. Let's go. Yeah. So bottom line is non-recourse mortgage secured solely by that. So at the end of the day, if it ends up being a WeWork scenario, I don't lose my house because I basically you're coming for the couple $100,000 I owe you. So fair enough. So you guys are really, I mean, that's I gotta say that is a lot of risk you are taking off the table for an individual and putting onto yourself. What is being taken in return?
Absolutely. So the payback in terms of financing is only after a successful exit. So Jason, a few things here. First and foremost, in a bankruptcy, right, the payback would be zero. Like you mentioned, we wouldn't come after him for that $1 million. In a good scenario, let's just say it takes about 4 or 5 years for the company to have an exit. When they're actually able to sell their shares, we'd ask them to pay us back that $1 million. We'll charge some fees at that point, right? So nothing is paid to us. There's no monthly or quarterly payments. This isn't like a mortgage or anything or a traditional loan. Everything just accrues on the account and is paid back in one lump sum after that IPO or acquisition. And as you can imagine, when it comes to rates and how we set those rates, they vary quite greatly depending on the company we work with, right? Series A startup that just started making money this past year is going to have higher rates than a company that is, call it, $10 billion 1 year away from an exit, right? It's just the nature of it. We're taking on less risk by working with a company that's $10 billion versus a company that just started making revenue this past.
A deck of corn that's already talking to Wall Street about timing on an IPO makes a lot of sense from a liquidity standpoint versus, you're right, someone who just, hey, we're still working out of a garage.
Absolutely. Exactly. And it varies quite greatly, as you can imagine, the range of companies we work with. We've done companies as early as a Series B pre-revenue company. Most companies we work with are typically in that 2-year to exit timeframe, right? Companies that just hit that funding round to get them over that $1 billion valuation, or I guess nowadays $2 or $3 billion valuation, and a lot of their employees are at that oh crap moment when they're going like, oh my God, my stock options are actually worth something now. I should probably do something about it. So usually that's the trigger point for people reaching out to us. It comes from both the individuals and the companies as well. Sometimes companies hear about a service like Secfi and want us to come in to do educational services and provide financing so their employees can exercise ahead of any future 409A increases or whatnot. Sometimes this is driven by individuals who come through the platform looking to exercise.
So fair enough. And then you also provide essentially liquidity loans, right? So I don't want to sit on my shares, have all my value in paper. Yeah. I want to live my life where I want to diversify my risk, where I've left this company and I want to start my own startup. Bottom line is I have a need for capital. Talk to me about that. Is it the exact same mechanism as the options lending, essentially?
Yeah, absolutely. It's the exact same mechanism. Both the liquidity and the option exercise structured the same way. We give someone $1 million of cash secured by the shares. In this situation, it wouldn't go towards exercising your options, paying taxes, but it would go towards liquidity purposes, diversification, putting a down payment on a home, paying for a wedding, whatever it is. And yeah, it's the same mechanism. But the underlying all this, right? Our financing is set up for individuals who want to go long in their shares. They believe in the upside. What I always tell people that come to us for either an option exercise or a liquidity scenario, if they think the company's at the top and they don't think there's going to be further appreciation, or they may not feel great, but maybe they think the company's overvalued, I always tell them, look to sell your shares. You're at a good point, right? May not be taking on that risk. We're taking on that additional risk, holding on to our financing. Our financing solutions are geared towards individuals who say, hey, I want to share in the upside of these shares. I want to maybe take a little bit of cash off the table today. I'll put a down payment on a home, diversify upside on my portfolio, with the idea that I still want to retain the upside in these shares. So that's the common idea behind our financing, whether it's an option exercise or liquidity purposes. But yeah, to answer your question, Jason, exactly the same mechanism, but the cash is used for liquidity purposes.
So looking at your calculator online, some of the graphics, I mean, you have two components, it looks like, of kind of the lending mechanism. You have both there's the exact term, waiting for this graphic to update. So you have an interest component and you have a stock fee component. So interest makes sense, right? However long that it's going to be there, I'm guessing you're going to compound that interest against the loan in the first place. You're not going to ask for liquid payments?
Yeah, correct. Yeah, it's going to accrue on the account.
Yeah. And frankly, if you are in a fast growing startup, then like single digit rates of interest are irrelevant compared to the vastly double digit growth rates of the equity. But then what's the stock fee? Talk to me about that.
Yeah. So the stock fee is how we share in the upside of the company. What I always tell individuals I'm working with, really the goal of our financing is try to put people in win-win scenarios, right? If you're looking to exercise with us, called an option exercise, idea behind our financing is that behind the win-win is that we'll help you save a boatload of money in taxes. After the exit, some of those savings will be given to us in the form of a fee. But at the end of the day, the hope and the goal is that you're still going to have more cash in your pocket than you would have if you didn't work with it, right?
And given these are non-recourse loans, I'm sorry, that's not a lot to ask. I mean, like the fact that it's basically like, hey, once you're de-risking yourself, and we're going to share that risk front with you, but we're going to need to share in the upside a little bit here too. And it's not like you're, looking at the numbers you have here, you have like low teens as like like a percentage share versus, again, it's not like you're taking 50 to 75% of it or making them cash out. They're not cashing out. They're still holding on. They're still getting the upside benefit, and you're licking the spoon in exchange for the risk you're taking on. So, I mean, that makes a lot of sense to anyone who would want to de-risk their situation.
Absolutely. Absolutely. And the stock fee is exactly how we share in the upside there. So if we, help you exercise 100,000 shares, we'd ask for a small percent of those shares. Now, the stock fee is what can vary greatly depending on where you're at within the stage of the company, right? It could be, call it in the single digits. It could be the low teens, like you mentioned, depending on what the stage and the risk value of the company is. The risk profile of the company, rather. But yeah, to answer your question, Jason, really, our business model is helping people get in that win-win. Of course, nothing is guaranteed in life, right? We have no idea what the market's going to look like. But if they believe in the upside of their company, they think the company's going to have a good exit. The idea behind our rates, our financing, we structure it. The individual will have more cash in their pocket if the company has a darn good exit. That's the hope.
But let's go back and face facts. Like, you are taking on risk here. This is not the same thing as lending a home to the tune of 50%, right? Like, that's a pretty solid play in most urban centers and all that other stuff, right? The bank knows they can sell. You're dealing with something that God knows when it sells, right? There's a fair amount of risk there. And if you don't take a slice of the upside, you're not going to get rewarded for the ones that don't end up selling for long periods of time, right? So it makes perfect sense. And anyone if you want to be fully greedy and not worry about monetization, then they wouldn't be talking to you in the first place, right? They're looking for something. So talk to me about consumer reaction. So thus far, how's the adoption rate been? How's the Valley reacting to this? I mean, I would think that this is something that's a welcome change, because This is not an uncommon problem in the tech world.
Oh, no, absolutely. And, just maybe going back to when I started at Secfi, call it 2018. So it's been about 3 years ago, right? When we started, it was our a stock option financing, lending, things like that is a relatively new industry. Not many people did it. A lot of it was done by VC firms who were doing special one-off deals for founders and execs as a favor for them, right? When we saw the opportunity here, we saw an opportunity to bring this out to the masses, right? Bring it out to everyone. Everyone should have access to something like this, right? No matter the regulatory nature of stock options, just make it a pretty crappy instrument all around, right? And we want to solve that. So adoption has been very interesting over the last few years, right? If you asked me 3 years ago, what it looks like, you had a lot of people that are somewhat skeptical, very candidly, right? We're at the very early stages, and like any new business, new startup, people are very skeptical at first. We talk to CFOs, CLOs thinking, hey, is this too good to be true? What am I missing? And maybe people are shelving it. It's like the easiest route is to go back to that tender offer. Let's just let my employees sell, because that's been done for the last 10, 20, 30 years, right? That's a proven model. But I think recently, over the last, call it year or two, its adoption has picked up rapidly. I think part of this is just the nature of, hey, this is an employee market right now, right? There are more job openings than actually employees qualified to take them right now. And I think what employers are realizing is that they want every competitive edge for their company. And they want their employees to be happy. And it's part of that, financial wellness, your stock option package, which is a huge reason for joining a startup to begin with, is important and very critical. So they're looking for services like at Secfi to provide that. And we're just starting, I think, if you asked me, like I mentioned 3 years ago, someone reaches out, a CFO or CLO reaches out about having Secfi come in to launch a startup, a financing program. It was unheard of. We never got that, right? Whereas you fast forward to today, over the last month, we had multiple executives reach out saying, I've heard about you guys. I want you guys to come in. We set up a program. We carve out an allocation for my employees so they can exercise their options. So I think it's picking up. We have a long ways to go, though. I think very candidly, I think the people that were familiar with this industry, there are a lot of sharks out there. There's a lot of quote unquote payday lenders.
Well, this is the thing, right? What was your alternative before? Without a open marketplace for this, or someone who's doing transparency like you are. A case in point, a colleague of mine left the company he was working for, and he basically, they're like, oh yeah, this guy, he's interested in buying shares and providing liquidity. And the first thing he basically did in the first email was like, there's a lot of overvalued companies in the city, and frankly, I'm not willing to pay those multiples. So what kind of shares do you have? And ended up basically like the lowball price he gave was just like, yeah, this is not even worth my time replying to this email, was what it basically came down to.
Absolutely. It's absolutely nuts. I think, when I first started here 3 years ago, I was doing a lot of market research into this industry, right? And I pretended like I was an employee at a fast growing startup. I talked to some of the other players out there, reached out. First off, very antiquated process, everything done via email. Seemed like they were trying to confuse me, to be honest. And I ran the numbers on some of these, and some of these were, call it 1.5x preferred return, number one. Number two, equity sizes of 40 to 50% of my grants. And I'm just like, wow.
Yeah.
You're pretty much taking an arm and a leg and then some, like what is going on here?
Yeah. Well, taking advantage of either desperation or ignorance, right? That's what it really comes down to.
Exactly. But that's a big thing that we're working towards, is getting rid of that reputation, right? I think sometimes people are somewhat skeptical of lenders, the big debt word, right? They're worried that they're taking on debt and whatnot. I think it's sometimes too good to be true. We hear it all the time. But a lot of this is education. We're getting it out there. We take a fiduciary approach to everything that we do. My team of equity strategists will work with every individual. I tell them, always do the right thing, right? Sometimes financing does not make sense for everyone. And we want to tell them that and be upfront with them. And hopefully we'll change this industry for the better.
Well, let's face it. At the end of the day, as much as it's not a big world, technology is a small world at the same time. And you get a bad name for doing the wrong things, and it's just not going to pay off for you. So before we wrap up, there's 3 questions I ask everybody to end on a positive note, and there's no right or wrong answers. First question is, if you had one wish for something to change in your industry in a company or the industry as a whole, what would it be?
Oh man, I think maybe going back to that payday lenders, I wish I could I wish I could take out every one of these bad, the bad reputation of brokers and, people just looking to make a buck off you, because it's, you have the lenders out there that are just looking to take advantage of people, really give our industry a bad name. But on top of that, you have brokers who are basically looking to buy shares off people at severe discounts. Again, doing the same idea, right? Taking advantage of people that don't know much, dangling, call it $100,000, $200,000, $1 million in front of someone without even letting them know what the valuation of their shares truly are. So I think that's something we're always constantly battling, right? The reputation of lending in general. And in this industry, a lot of people have some bad taste in their mouth from bad experiences. So if I could do one thing, I'd love to wipe out all that experience. But again, it's work in progress, and we're hopefully changing that.
Excellent. Second question is, what's been the biggest challenge in the company to where it is today?
The biggest challenge, I think, going back to, just overall, just understanding that an industry like that bring something new out to the world. Like I mentioned, I think there's a lot of tender offers, secondary sales. People have been buying, selling shares in secondary markets forever, right? But financing stock options is a completely new industry. You kind of have to, it's relatively new, at least in the masses, right? It's made readily available to everyone is relatively new. I think the biggest challenge is really spreading the word around that there's something like this exists, right? It's even to this day, even with the marketing team and a lot of VC money throwing ads out there and marketing and branding, right? A lot of people still come to us to this day, 5 days before their exercise deadline, for example, and they say, hey, I didn't know service like yours exists. Can you help me? And it's absolutely unfortunate, right? Because I think there's a lot of money that's being left on the table out there. And when it comes to stock options, we ran a report last year called the State of Startup Stock Options, and we forecasted that out of the companies that went public, employees left $4.9 billion on the table.
Oh my God.
That's a lot of money by not exercising our options. And that number will never go to zero.
That's compensation they were entitled to that it didn't exercise for one reason or another. That's just
exactly.
That's unfortunate, highly unfortunate.
Yeah. And that's by far been the biggest challenge, getting word out there that services like this exist, because it's completely new and not a lot of people understand it, right? They don't understand how financing can help them, and stock options in itself, complicated as all heck, as you know, Jason, and I'm sure you help out a lot of your clients with stock options. A lot of people like to put it on the back burner and not think about things until it's too late. So it's a challenge that we're facing and we are working towards as well.
Excellent. So last question for you is, what excites you the most about what it is you're working on, keeps you getting up every morning to keep on fighting the good fight?
Absolutely. I would say the best part about this job, and it's always been this way, what gets me going every day is I get to help people out on a daily basis, right? My previous gig, I was at PricewaterhouseCoopers doing taxes for hedge funds and private equity firms, switching over to the individual level, right? We're helping solve a very complicated problem that a lot of people in this industry have. And when you solve that problem, help an individual go through an exit for the first time, come upon wealth for the first time in their life, the joy and happiness you can provide that individual, it's just, you can only imagine, right? I get texts all the time, emails all the time from clients who bought their first home, starting their own families, for example, paying off college tuition and whatnot. And it's just a fantastic feeling. Individuals are very, very happy. Help provide a great service for them. You give them great sound advice, let them know, hey, we're here to help you. And whether that solution is a financing solution or another means, or if they're using their own cash and they go through that exit, have that first big windfall, there's nothing better, right? And hopefully it comes around for us as well as Secfi.
Excellent. So Vijay, thank you so much for taking the time. I really much appreciate it.
Absolutely. Thanks for having me, Jason.
My pleasure. So that was my interview with Vieje Piauwasdy, the Director of Equity Strategy at Secfi. I hope you enjoyed that. And if you are working at a technology company and have a bunch of options or shares that you need a liquidity event on or need to exercise, don't leave that on the table. Be sure to check them out. As always, if you enjoyed this podcast, please leave a review on Apple Podcasts, Stitcher, Spotify, or wherever you get your podcasts. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonpereira.ca.